Hi everyone, welcome to the webinar and the live market update. Exciting times again, given the movements of the markets in recent weeks since who became head of the United States. Now, here we go. Let me take you through quite a lot of slides I've got. As ever, let me know you can see and hear me. Peter, great to know you're in Auckland, New Zealand. Nilesh, hi. Mark, good evening. Welcome one and all. We're also live on TikTok. For those who are on TikTok, you can find me on alpeshpatel.com/links if you want to watch this webinar. Okay, so I will let people know on my Telegram channel as well. And we've got quite a lot to cover this week because obviously started the new month, and therefore get your pens, papers ready, grab a drink, and make sure you're ready for everything. For those who are not on the the Telegram channel, this is what it looks like. I do not have one-to-one conversations with people on Telegram, so be careful of scammers trying to get you onto Telegram to talk about one-to-one conversations and their crypto. That isn't me. My links are all at alpeshpatel.com/links. Okay. One of the things that I came across just recently, and before we kick off, as you all get comfortable, thank you, fantastic everyone. Christmas drinks, then Ruth, is excellent. Christmas coming early a bit for a lot of people. I was reminded of this one that I got in April. Sorry, I've not been in touch. Joined the Great Investments Program in 2021. Started with 100k to invest in 2021. Has added a bit of money since then. Today has got nearly 400,000. I'm over the moon. Okay. He's added 40k cash to that, 20k a year, and I had another 20k this week. Okay, so that's what, 60k. So from 160 to 400k, very happy with that in 3 years for one of my students. And one of the things that he's learned, which was really helpful for him to tell me, is selecting stocks from the filtered list. So we're going to go through that. Charts, I'll go through that with you in this webinar too. Analyzing the charts, I'll go through that with you as well. How to invest in a particular stock, when and how to add positions if they continue to be on the list, when I exit, by how much, adjusted the risk management profile. So I'm going to go through all of this, what led to this particular student going from 100 to 400 in that 3-year time frame. So I'll cover that in this as well. Of course, it's always easier to get returns when the markets are rising. And for 2025, Deutsche Bank expect a 17% rise in the index. Now, a 17% rise in the index may well translate into significant gains in individual stocks, but I suspect there'll be a lot more stocks which are going to get punished if they miss targets. So we've got to be very careful. Nevertheless, of course, the safest thing can be to maybe even do a leveraged ETF on the S&P or NASDAQ. So we'll look at some of those funds which have low downside volatility and some potential upside return. Okay, so a lot of people very positive. The other thing I wanted to show you was this from a while back that I did. I'm not saying there's going to be a crash. What was interesting, and this is a point people often miss, is there are some times when we need to hold cash. Once in 7 years, you have to hold cash rather than any stocks. That's not right now, of course. The reason I want to show people this and explain what's going on here is this. These are the Dow 30 stocks, okay? And this is how they performed in the last financial crisis. I'm talking 2008. Notice how pretty much they all fell simultaneously. So this notion that you can diversify away a crash is absolute nonsense. When pension fund managers, St. James's Place say, oh, don't worry, we've invested in lots of different sectors and all the rest of it, you can't diversify away stock market risk. If the whole stock market's falling, then you need to be out of it and holding cash. Like I said, once in 7 years that happens. I'm going to show you something of how we avoid that problem. As I say, roughly once in 7 years. It could happen for the rest of our lives from tomorrow morning. I mean, nothing's guaranteed in the future. But the way in which, for those of you who don't know, and there's no particular reason I'm mentioning this now. I'm not expecting a crash, but what I'm saying is these spectacular gains that we've had in the S&P going up and up. If you look at that year, 2022, for us, it was just simply looking at the average prices, which gave us the heads up, that pattern. Now we're breaking through it, which is unusual. This seems to be going up and up and up, a bit like Nvidia last April, where you thought it's peaked, but the averages are just going higher. And whilst I'm not necessarily saying we're going to get a 35% return over the next 12 months, we're aiming for that on the upside, but we're keeping an eye out to make sure we don't get what I call a daddy bear, these short and medium term average prices falling. Okay. And that's critical, because if they do fall, that's the time we want to be in cash, because whether you're holding Coca-Cola or Procter & Gamble, two very different companies, and you might think, well, I'm diversified. I've got Procter & Gamble and I've got Coca-Cola. Well, they both fall. In other words, when markets fall, then everything's correlated to the downside. Okay, there's very rare exceptions. And you might think, well, that's okay. I'll get Coca-Cola or I'll get McDonald's. Well, actually, they're quite similar companies in many regards, and yet one fell, one rose. And you're not going to try and pick the few that rise when everything else is falling. I don't think you'd have the guts for it. So I'm just saying that we need to keep a lookout on the downside, and the downside for me is that whilst we're all looking at the upside and all getting very excited about how much money can be made, my job is also in these weekly updates just to let you know in case there's any danger clouds on the horizon. There aren't at the moment, and that's fine. The big question I get asked at the moment is, when do we take profits? And that's one of the things that I'm going to address today as well. It's come up in a couple of emails I've got today and yesterday from students. So I want to deal with this first, then we'll go through the stock market update. This one, for those who can't see it on screen, if your screen's a bit small, just contacting you regarding the stock HubSpot, which I bought on your hedge fund pick. It has since gone up over 30%. I started with a 50% allocation, and because it went up, I added an additional 50% on your recommendation of adding to winners. All data looks really good, etc., etc. I'm thinking of doubling my allocation to this stock. As I saw in one of your posts, you said you like adding to winners at the moment. So I gave an explanation to this individual and explained to them the downside risk, but it raises the bigger question, particularly in a buoyant market like this: when should you take profits? When should you add to winners? I'm going to address that in a second. I had this one as well. This was in Ripple, which was 2 days ago on Monday. Hey Alpesh, this is purely for fun. I remember when I first joined the Great Investments Program, you mentioned you were going to buy some Ripple, buy and not look at it. It literally did nothing for ages and suddenly happened to have a quick glance and it's up 254%. Okay. So again, what do you do in that situation? What's the exit strategy? It was a third one that came this week. Hi Alpesh, hope you're well. Partly out of interest, I decided the stock to buy in mid-October was Toast. This Toast is the company, not what happened to it. This, I believe, was one of your intermediate term picks. It was indeed. It has gone up roughly 50% in the meantime. And as it has somewhat stopped rising, I'm considering what to do. Should the general strategy to be sell if it goes up 40%, etc., etc. So this begs the question, what do we do? He doesn't want to lose the additional 20%. This is the general rule I have. Okay, when you've got profits, it's this, the exit rule C. If it drops X percent, like 10%, 15, 20, 25, and X you can easily work out yourself because it's 10, 15, 20, 25. From the high, sell Y percent. Okay, now that you determine based on your risk appetite. What those exact numbers should be of how much you should sell if it drops from the high since you've bought it, you would know what the correct answer is in hindsight. Well, hindsight's no good. Or if I had a time machine, because we don't have hindsight, we've got to base it on our own risk appetite. Okay, and that makes it bespoke to your risk appetite. Now, if you're very risk averse, you might sell out and you find in hindsight you sold out too early. That's the major problem of being risk averse. If you're too risk loving, you find out you've left it too late to sell and it pulls back a lot, 50%, and then you think, oh my God, I've just lost half it. So usually there's a happy medium which comes with a bit of experience that you might take a little bit off as it drops 10, a bit more at 15, a bit more at 20, etc. Okay, and that's probably the best rule I would suggest for people to use. Nothing's perfect. Nothing will maximize your gains other than a time machine and hindsight, but that one will allow you to look in terms of risk appetite. Okay, as well. Thank you for some of those questions. I'm going to answer those a little bit in a short while. Okay, this has been the past month. I've shown these before, so I won't go through it. I was luckily at LinkedIn. I've got another event on December the 10th in Parliament on cybersecurity. I like looking at these scale-up companies and hosting them for events because I get a good insight into what's happening in the listed markets as well. That was one of the events at LinkedIn. I've mentioned Tulsi before. That's me at her offices in previous years. For those of you who don't know, well, look up what she does now. Anyway, let's get back to the stock market. This is what I'm going to show you a little bit later on, why I look through 10,000 stocks and need all of these first 5 columns to be all green. Okay, and the reason is, for those of you new to this, we want undervalued companies which are growing. Those people who tell you, oh, we only do valuation. Some of the big funds will say this, like Fidelity or Vanguard. Well, they're just trying to sell you more products, because actually you want your portfolio, your pension portfolio, to do everything. It has to tick the value box, has to tick the growth, has to tick the income box, because we know from the academic research, those are the companies which tend to do the best. And also, whilst we're at it, the momentum box, okay, and the cash flow box, amongst others. And there's very few companies which sit right in the middle, right over there. Those are the ones we want. That's not to say you can't have a company which does incredibly well outside of there. It might be a meme stock. It might be one that Elon Musk mentions, but that's not suitable for our pensions, our SIPs, our ISAs, 401ks. So just as a reminder to everybody, Croakey from Goldman Sachs Wealth Management, we want companies to be in the top quartile because their research department showed, and I'll show you the slides a little bit later, companies in the top quartile tend to, as a group, on average, generate 30% per annum. Not every company in the group, not every year. So in the financial crisis, none of them did, of course, but overall, over 12 months, 30% per annum, because they're generating a lot of cash on the capital they invest. Capital, they invest once, cash keeps coming out. In other words, becomes closer to being a cash cow, basically. Undervalued companies we know do better than overvalued ones. Growing companies do better than ones which aren't. The weighting for those, value is weighted twice as much as growth, as much as income. Now, the reason that proprietary algorithm is incredibly important is because the research which went into it came not from me. It came from my Financial Times columns, my books. It's been published in those. It came from Daniel Kahneman, Eugene Famer, and Richard Thaler. I took all of theirs, aggregated it, and put it into those algorithms. They all went on to win the Nobel Prize in economics, actually. So I cheated. Just as I invest in other people's companies, ride their coattails to make money, and I don't invent the companies. Similarly, I didn't invent these ratios. I rode the coattails, in this case, of Goldman Sachs Wealth Management and what they tell their wealthiest investors. So it's the same principle I have in investing. I've taken to working out what to invest in. I just stand on the shoulders of giants and geniuses. Okay, which, I'm not going to create Facebook, but I know I can invest in it. So value, growth, income. Again, if you want to go to Vegas, you can make money there, but this isn't Vegas. This is the pension type of investing you want to be doing. 6 month, that's because from the hedge fund industry, which I come from, trends tend to persist. There's ample research to show that. They're not guaranteed to, but they tend to. And that tend to is what you need to give you the edge. And you want to tick that box. Sortino is basically average returns and low falls from it and quick recoveries. So drawdowns are shallow. And durations of drawdowns are short. So short in duration, small in size drawdowns. That's what the Sortino measures. It's a simple formula. I couldn't even remember it. It's been ages since I've sat my regulatory exams for the FCA, or it was the FSA back then. I can't remember what the formula is. You can Google it, but the point is, it's a simple mathematical formula which looks at share prices and says, well, has it got a really high average return? You want that to be as high as possible. And is the downside drops really shallow? So you're basically looking at something which is very skewed, for those who remember their maths, to the right-hand side. Okay, so that's one thing. Now, this is one of the portfolios one of my students sent me. I really like this, and I want to share this insight with you before, as I said, we go on to the rest of the stock market update for you. And by the way, don't forget, if you're on TikTok, like and follow, and I'll post this later on YouTube as well. These are the ones he decided to have. Now, notice how he's done his allocations, suitable for him. They're not going to be suitable for everybody. Okay, he's done leverage, 2 times. Suitable for him. We discussed his risk appetite. He's done well. United Health sadly lost their CEO, but the stock price was up today, and he's got a bit of Tesla and Nvidia. So nothing earth-shatteringly novel in the picks. What I wanted to show people was this: he researched how much it dropped last time, looking at the charts. Looked at the potential loss that would mean for him. He looked at recovery time, so his expectations were managed. He's looked at his own stop losses and what he might want. Now he's got a bigger stop loss than I would have done, but I like the fact that he's aware of the downside. That is a good professional approach. I make this available to students on my Great Investments program as well. Thank you, Ian. And keep the questions coming. I will answer all of them as we go. Well, probably at the end, actually. So thank you for the questions on the webinar. For those who, as I say, are on TikTok, have a go to alpeshpatel.com/latest shares if you want to watch this on a computer screen or on a phone, as opposed to on TikTok. Okay. Now, this is from Goldman Sachs Wealth Management. It's not controversial, and this is years to retirement. If you think you've got 25 years to retirement, you might want to have 90% in stocks and 10% in fixed income, for which read cash in a bank account. You should be able to get on sterling about 4.5% at the moment, and on US dollars 4.2% instant access. Okay, that's fixed income. The rest in stocks. Now, how long should you hold the stocks? How much should be in stocks? How many stocks? How do you know when to exit? I'm going to answer that. So you've got a simple process. It's very important to have a simple professional process so you're not confused. And most importantly, you're not wasting time, because time is money. Now, within there, you might have a batch of exchange traded funds. I will go through exchange traded funds as well. In fact, what I'm going to do later on is I'm going to show you why we look at 10,000 individual stocks. Look at all these. None of these meet my requirements. So you can see why the requirements are very stringent, because you've got 10,000 stocks to go through and you want all of these 5 columns to be green. You can see why you have to be, first of all, starting with a large number so that you can filter very, very tightly. Okay, so you can avoid all these ugly ones, 70% down, 90% down, 72, 98% down, because that's what the stock market can do. And as we go higher and higher, we get a higher quality of company until all of these are all green. Now, I will show you as we go forward the ETFs as well. And we'll talk about exchange traded funds and why I do like them and how you can balance the risk to the downside with individual stocks and the lack of reward with just having cash by having the in-between, which is exchange traded funds, which will give you less of the downside risk and falls, but can still give you the upside gains. Okay, and how do you decide which ones do I like at the moment, which have I just invested in, so on? We will cover all of that. Okay, so we will do that. Thank you, Mark. I'm going to read that out in a little bit, and I will address that as well. Okay, the number of people who've not made any money waiting for the inevitable crash for the last 12 years is phenomenal. So we've got to be careful about inevitable crashes. Yes, the markets fall, but they tend not to fall 20% in 3 seconds, in which case you just couldn't even get the heck out. If you look at like this, the inevitable crash of a 20% drop, that took a year. Okay, you had 1 week, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Within 3 months, it had only dropped 10%. We knew to exit last year because the moving averages, the average prices, short and medium term of that were dropping. Okay, simple rule that we use. If the average prices are dropping, so we very much on the exits look at just momentum, not narratives, not trying to outsmart the market, not trying to say we know something everybody else doesn't. We don't. Okay, we just look at where people are putting their money and not putting it. That gave us 3 months and just a 10% drop. I'll take that any day. There's your crash for you. In other words, when something's crashing, falling, you don't have to just sit there and look at it for a year and go, oh shit, I'm losing money. The people who want you to do that are the fund managers and the wealth managers, because they earn fees whilst you're in the market. So they want you to be holding on during a car crash. They want you to be staying in there while the house is burning because they're earning fees the longer you stay in the burning house. But if the house takes a whole bloody year to burn and hasn't got to your floor after 3 months, you might think to yourself, do you know what? Why don't I get out of this? Which is holding cash. Once every 7 years, you'll get that kind of drop. And I can just show you the images. Roughly, it's once in 7 years. Might not happen again. Okay. This one happened so quickly, you didn't even have to get out because it just dropped and came back up again. It just rebounded so quickly. That was COVID, by the way. Okay. Now, that's not to say that we might not have just peaked the market and we'll never have an up market ever again. No stock is ever going to rise ever again. That could happen. That could happen. But what I'm saying is, if we just keep saying there's going to be a crash, there's going to be a crash, there's going to be a crash, whilst 1987, 90, what was it, two-ish, 2000, 2008, COVID, 2020, whilst all of these things do come along, the trick is not to do what the wealth managers do, which is drag you all the way down. Okay, because you're not forced to sit in the burning house or in the boiling pan like a frog being gradually burnt. Look at this, that's a 73% drop over a year. The funds like Blue Whale, that lost 27% that year, or Scottish Mortgage Investment Trust, that lost 50% that year, is because the idiots just kept holding on. And those are the bloody experts. You know, it's really easy to exit. There's a button, go sell. How do you know, Alpesh? So just can look at a simple moving average, that one, which is what we said in January of that year. Now, luckily, that happens rarely. Like I said, once in 7 years, roughly. And the reason it's important to be out of that, other than the psychological reasons and the fact that your pension has just lost 6 years of value, and and the second home you thought you were going to buy in the Bahamas isn't going to be there, and your wife just divorced you at that point, is because not that, oh, well, over 2 years, if you hold it, which is what the IFA will say to you, if you hold it for 2 years, look, you come back to zero. Well, no, because if you miss even half of that drop and got even just half of the gain that came, then over 2 years, you didn't make zero, you made 100%. That's what happened there. Now, that's meta, and it's an extreme example, but it actually happened alongside all the other ones. So, yes, this will happen again, but I'm not going to sit there in the burning house and watch 73% of value being diminished. This is why we do a weekly, well, twice weekly update. We're just looking to see if the average prices are dropping. When they drop, tends to be a pretty good indicator, not necessarily guaranteed in the future. Who knows what will happen in the future? Putin might nuke us tomorrow morning, but it tends to be a pretty good way, better than looking at narratives and trying to guess the future and trying to outsmart the market of when to get out and hold cash. So you're absolutely right. Markets do fall and they do rise, but that is not the reason not to be in them unless you are particularly risk averse, in which case, and I mean this in all seriousness, if you are risk averse, let's say, for argument's sake, I'm talking to a 90-year-old widow, the proverbial 90-year-old widow, who should be risk averse. You should not be in the stock market. You should just have cash because you're going to need it, obviously. Okay. So I just wanted to explain what actually happens compared to what people perceive happens in the market. Anyway, these are the factors we're going to look for. Because I'm very much on the cautious side. Why am I on the cautious side? Well, bloody hell, I've been investing long enough to know to be on the bloody cautious side. If I want to be gung-ho, that's really simple. I take a flight to Las Vegas. How much are the flights right now? Okay. Cheap as chips, and I can get my gung-ho-ness. Caution means I need to tick the stocks which are undervalued. What does undervalued mean? Imagine you've got a rental property. Value people find really difficult to understand. Growth, everybody understands. If I say to you profit growth, revenue growth in a company, you get it. Sales growth. Sales and revenue means the same thing. Profit and earnings mean the same thing. Okay, you get it. I understand. Sales have gone up. Profits have gone up. That's growth. Value people find difficult. Let me explain it like this. Let's say you've got a rental property, and there's many different ways to measure valuation, but I'm going to give you one example. And the rental property pays £1,000 a year in rent. Okay, and I come along and I say I'll pay you £2,000 for that property. You'll say, get lost. It pays 1,000 in rent. You'll make your money back in 2 years. No, it's too cheap, and you know it's too cheap because I'll buy it off you and I'll sell it to somebody else for 4,000 because it was cheap, or 8,000. But let's say I said to you, I'll buy it off you for $1 million. You'd go, what an idiot! It only makes 1,000 in rent. That's too expensive. Okay, I'm teaching you sort of 101. but that's valuation. We want to make sure we can pick things up which are relatively cheap in price for the profits we're getting, but we also want them to be growing. Okay, we want momentum. We want some dividend yields because we know that puts a floor on the stocks. It's not guaranteed to. Sadly, none of this is guaranteed. If it was guaranteed, I'd be the richest man in the world. Okay, because then there'd be just simple formula to pick one stock. I'd leverage that to the hilt. Bingo. Even Warren Buffett doesn't have just one stock. Cash flow, really important. If you don't believe me, COVID. Didn't matter what your balance sheet looked like, didn't matter how much profits you were making or what your sales were, well, they were next to nothing. If you did not have cash flow, you were dead. Okay, and some reserves in cash as well. So 2.5, I've mentioned. Monitor him frequently. Now, you might think this is odd. And the reason you need to monitor him frequently is the more you keep staring at an investment, a 12-month investment, you keep pulling up the roots every day to the plant goes dead. You got to stop trading your investments and panicking. If you panic, it means you've taken too much risk to begin with. In other words, you pick something with a greater volatility, a drawdown, a greater fall in price than you're comfortable with, which you shouldn't have done. Okay, and which takes longer to rebound, which you shouldn't have done. So a too low a Sortino, and also it means you put too much money in it. Classic mistakes of most people. They underestimate how much something could fall. They underestimate how quickly the recovery is. They underestimate their own impatience, their own fear. They always think they're braver than they are, and therefore they end up trading their investments and they put too much money in things. Okay, so they're over optimistic. And self-deluded. So my job with them, a bit like a psychiatrist, is to get them to understand what's suited to them. Now, that's fine. If you're risk averse, that doesn't mean less returns. It just means less choice, which is fine. It means that it'll take a bit longer to get the ideal portfolio suited to you, but it doesn't mean necessarily less returns. Okay. And for me, it's 12-month holding periods. It's between 15 to 40 stocks. Some ETFs can be thrown in there. And if it drops, as a general rule, but we can make this bespoke, 25% from entry, you'd get out. That's a general rule. I'm giving a general rule because I'm not giving individual advice here to anyone. One strategy: value, growth, income, cash flow, Sortino, alpha. If one works, why the hell do I need one about, well, let's look at meme stocks. Let's look at what Musk says and all of this. Okay. And this is essentially the reason why you want about 20 to 40 stocks. Over 40 and you're over diversified, you're not going to get a decent return. That's what most fund managers are like. They're pretty rubbish. They spray and pray because they've got so much capital to deploy, and they've been told you can't invest from the universe of stocks. You can only do the UK ones because you're the UK fund manager. So they've got their hands tied behind their backs, and which is why when you go and ask your IFA and test this, I've got so many clients who've joined me from St. James's Place. So ask your St. James's Place fund manager, first of all, was it a multiple choice exam they had to take in order to become an IFA? And they'll say, oh shit, yeah, you're right. And then ask them, how did you do in 2022? Why didn't you tell any of your clients to hold cash? Right? Because they wouldn't earn fees if they told them to hold cash, so they'll never do it. It's a massive conflict of interest in the industry generally. I've written about this in my Financial Times columns. I've written about it in my books published by the FT. I've talked about it on the BBC. So this is not anything new or original. I'm not the first one to say it. Eugene Fama got the Nobel Prize in Economics for proving all of this. Company-specific risk can only be removed, market risk can only be removed if you're in cash, i.e. outside of the market. Like I said, once in 7 years, you'll probably want to be in that situation. As I said, I've written about this in many books. Indeed, Barclays even did one of my book launches. That's one of my book launches. Okay, so it's not as if this is just, some bloke on the internet's come up with this. By the way, so let's go on the stock market update. I've spent a bit longer than I wanted on the educational part, actually. Goldman Sachs rated Microsoft, buy JP Morgan, all of this. By the way, I just discovered about Amazon that it earns more from advertising than Google. Amazon makes more money from adverts than Google, which is amazing. I've been a bit lazy recently. I put it on my private Telegram channel that I've been adding to my winning stocks rather than picking new original ones. I have picked some new original ones I'll come to. And so, by the way, I own all of these except Meta, which I got out of only in April because it was such a large component of my son's investments, his junior ISA, that every time Meta moved a tiny bit, his portfolio it needed rebalancing basically because it had gone up stupid amounts since January of last year. So he'd had it in his ISA and he'd had 2 times leverage as well. So he'd had it up to about here, and it was about 500%. It would just become outsized compared to everything else. It wasn't quite in January, right at the start of January, it was sort of closer to this, basically when the average prices started moving up, which was about the first or second week of January last year. Okay, so ideally, yeah, and I've said it before, perhaps I shouldn't have sold all of it. I should have reduced each of the holdings just to rebalance, but that's what had happened. Tesla's been a recent repurchase. I'll come to the charts on it later, but I can show you now if you wish. Okay. Tesla was a recent repurchase again as the moving averages started going up and as you know who became president. So that became an easy one to do. And I actually said to you why we'd got out of it before in last year when the MACD was falling last October, and why we got back in here. Now, with this, it's really simple. That's the projection, and the downside risk from when we got in is pretty much that 35% to the downside, 139 to the upside, and I don't even think that 35 is going to happen to the downside. Okay, and it's got very little to do with the cars, by the way. It's got next to nothing to do with the cars. Now, S&P 500 back to back plus 20% gains. You might think, oh, Alpesh, 2023 the S&P rose. 2024 it's rose. So now I've just got to sit back and, if you don't mind me saying, Mark, wait for the crash. I don't want to get in the market. There's a group of people that'll always be on a train platform waving the train goodbye. And I know some of them from the year 2000. Apple's never going to invent something new. Microsoft's had its day. That's from 2000, 25 years ago. They're still waiting on the platform for that train to come back. They're getting old. And similarly with this. Now, I don't care if the market rises or falls next year because I'm not a brokerage trying to sell you brokerage services. I'm not a retail fund manager trying to sell you my fund. I'm not an IFA. So I couldn't care less whether it rises or falls. Okay. Of course, I'd rather it rose because I'd make money. But if it fell and I had to hold cash, great. We get that 1 year out of the way. It's a bit like Russian roulette. We'll get one of the bullets out of the way. And the rest of the chambers, we should be rising. But statistically, the third year tends to be a good year. Statistically, that's when you've had 2 years in a row. Now, what happens if you get 3 in a row? You're probably going to get a down year. So I suspect next year is going to be up and the year after might be a down year. I reckon 2026 will probably be holding cash. Okay, doesn't matter. Let's see what we can do in 2025. 4 and 3 have been phenomenal. And in case you're wondering, so how did you do in 2023, 2022 when the market fell? Okay, 0%, nothing. Alpesh, but you're supposed to be clever, you little show off. How come you made no money in 2022? Well, on the stock investments, next to nothing. I was looking at some of the energy stocks in July of that year. You might recall from some of my videos, we had some energy stocks, not much money in them, made a little, ignore it, call it zero. The markets fell. In that year, you might say, well, surely you could have found some companies which rose. Yeah. Eli Lilly, I looked at, rose that year. Why didn't I invest in it? Because it did rise. Well, let me put it this way. If 99 companies are falling and only one's rising, do you think I've got the balls to go put my money into the one that's rising? No, that ain't me. Might be somebody else. That isn't me. That's not me. I'm not that guy. I'm going to do it. I'll just say, hey, thanks. Like I said, we had some energy companies. I think Targa Resources was sort of the standout one, but I didn't put all the money in that. Obviously, it was a tiny amount. The market was falling, so call it 0% in 2022. So there'll be 1 year where you get 0%, but that's made up for the other years where you make up for it. It's like one day you fast, all the others you overeat. Okay. Now, yes, I know they're expensive. US equities are expensive. This is sourced from Bloomberg. Don't worry about what all this means. Basically, we're expensive. Now, I'll go into that in a bit. By the way, for those of you who don't have all the links, alpeshpatel.com/links is where you'll find everything from connecting with me on LinkedIn, my latest articles, which are all free. There's a free investing course on there, a free copy of my book, Investing Unplugged, one of my 18 books is there. My webinar, You can watch live as well. Free Financial Times Internet Trading Course book. Oh, I didn't realize I've made that available as well. I have. The Complete Course in Online Investment by Alpesh Patel. That's free. That's published by the Financial Times, and my free daily Telegram insights as well. So there's a bucket load of free stuff on alpeshpatel.com/links. Okay, and it covers UK and US. Now, going back to the markets, when I said they're expensive, this is what I mean. You're paying $28 for every dollar of earnings in a particular company. So you're paying, in the case of Microsoft, $28 for every dollar of expected profit that Microsoft makes. Why would you do that? That's expensive, because we know for Verizon, you only have to pay $9. For Berkshire Hathaway, you pay 20, so it's cheaper for every future dollar of profit. So JP Morgan, which I own, $14. Okay, where's Goldman Sachs? It should be in there somewhere, which I also own. Okay, so and Tesla, you're paying $104 for every future dollar of profit. What the hell's wrong with you, Alpesh? Well, what this shows is, if you think about what's been moving the most, it shows you that valuation is not the only thing that moves prices. If it were, then you would just avoid all the ones in red and buy the ones in green. In fact, if you did that, there's Goldman Sachs. If you did that, you would have made very little money. Okay. We'll come back to that, because growth is also a factor that moves stock prices, not just value. That's why sometimes people say there's going to be a crash. They're focused on valuation, not on growth of profits, not on cash flow growth, not on momentum. They think momentum's a dirty word. Well, the hedge fund industry, my industry, and you look at Winton Capital, who are based out of Hammersmith of all places, or Brevin Howard, or AHL. All of these hedge funds are momentum based. JW Henry, who owns Liverpool Football Club, momentum based hedge fund. That's just even momentum, not even looking at any of those fundamentals. Renaissance Technologies, a lot of their strategies, and that's the most successful fund in history. Okay. Anyway, earnings which are coming up, nothing which is going to move the markets. Okay. Oracle potentially, but probably not. That's got its earnings on Monday. Okay. Adobe, not really going to move the markets, but those are the earnings that are coming up. So you might want to have a look at some of those. Don't forget to do all of this. We've still got a lot to do. Sorry. So please do follow. Now, I've already mentioned that that's what we look at. So let's look at some of these stocks and how to do it. This is the past week. Okay. Thank you, Ruth. I will answer this. I will answer these questions in a moment as well. Sahil, if you want it, I'll do one on Bitcoin and ETFs. There is one to be done. I think you're absolutely 100% correct. I've just been rather busy with, but what you guys want, I do. Okay, over the past week, this is, and there's a fair bit of green. Do you remember how these were all the overvalued ones? What the hell? Okay, and what's going on over here? So let's have a look at, is there money to be made by having those other ones? By the way, over the past year, this is what makes me look clever. Now, some of you might say nothing could make you look clever, Alpesh. You're a lost cause. This makes me look clever. I could not, and I regret it, that I don't have those innate abilities. I could not invent an Amazon. I might have the idea, but I couldn't execute. Or an Apple, or a Microsoft, or an Oracle, or an Nvidia. I knew that from when I was 12 years old. So I would buy shares in those companies from money borrowed from my aunt. I grew up in Leeds, in Armley I was born. So if you know it, it's a pretty poor area. So with a little bit of money borrowed from my aunt, I would buy shares, the privatizations. Why? Because I thought, if I ride those people's coattails, then while I'm at school, they're working for me and I make money. It's simple. And that idea hasn't changed. I've still got the mindset of a 12-year-old in many ways as well. Mark will answer that shortly as well. Okay, so Google, Meta, and all of these. Now, of these, you'll know if you're a regular follower of mine. Let me know if you're a first-time viewer. Put it in if this is the first time you're seeing one of my webinars. Okay, when you get this much green, my life's really easy. My pension's easy. My wife's happy with me. My son, well, he's only 6, so he doesn't know too much, but he's probably pretty happy with me because daddy looks really clever. It's been like that this year. It's been like that last year. 2022 was cash. The year before that, it looked like this. And the year before that, it looked like this. Will it continue? I do not know, because I cannot guarantee the future. But I could probably say, as a relatively intelligent person, yeah, I think we'll get 5 years out of 7, which will be good, 2, which will be more like 2022, where the market's just like, listen, we better hold a bit of cash and stay out of the way. 2022 is why people get pissed off with St. James's Place, the IFAs, the wealth managers who underperform, don't produce growth. Because you look at this and you show your IFA wealth manager and they'll say, oh, no, you don't want those big tech American companies. Okay, well, what about the big American banks then? Oh, no, you don't want those. You don't want America. Oh, very risky. Oh, if you have America, you want a little bit. Well, what about the drug companies? No, you don't want those, because they haven't done it. And because they haven't done it and they've effed up your pension, they've got to now come backwards and say why they're producing piss poor results. And they keep doing it and they keep destroying the pensions of British people. ETFs 1 month performance, I will say I'll do a separate one on, for instance, crypto, ETFs. And in fact, I've actually got a screen that I'm going to show you, which is a new one, which will actually show you some of these ETFs, but I will do a video on that. And I know I keep promising, but I will get around to it. To do one just on these. I've done one for my clients, but I haven't done one for the public. This is the US market price to earnings, which we know is expensive. Okay, the average is about 30 is the 1 year average. That is expensive. In other words, you're paying $33 for every dollar of profit something produces. So that house, which produces rent of $1 a year, you're paying $33 to buy that house. Why would you buy a $33 property which only produces $1 in earnings? Well, because you expect profits to actually grow. You'll be able to increase the rent on that house. Okay. But yeah, there's no denying it is expensive. So we need vigilance. When I was doing my Bloomberg TV show back in 2000, before the crash and after, I always used to say, I know it's going to crash at some point. It's a bandwagon. Everybody's jumping on. The trick with a bandwagon is to jump off before it falls off the cliff. I've written that in my books. I said it on Bloomberg at that time. And then as the cliff started appearing and we were falling because the average prices were falling, we said, let's get out. We didn't know how far it was going to fall or whether that was the big one. Okay. And I'll show you in a second I'll show you now how you tell. Okay. Daddy Bear looks like this. Basically, average prices are falling steeply. See this bit where my thing is? A mama bear, see that where the prices are falling, but the average prices haven't fallen below the yellow line, which is its own average. It's an average of an average. Then you can ignore it. It's steep, it's painful, but you can ignore it. And baby bears, to see these falls, you get about 3 or 4 babies in a year. You get 1 mama a year, and you get 1 daddy every 7 years. Okay, roughly. And you can ignore the baby bears. So when baby's crying, small falls, average prices are rising, ignore it. Okay, I can sit calm. No point do I read narratives at that point, what's happening in the news and all the rest of it, because psychologists will tell you, Richard Thaler, Daniel Kahneman, Nobel Prize winners, that you can achieve any confirmation you want from narratives. Just ask the viewers of Fox News and the readers of The Guardian. Okay, can confirm anything you want to have believed. Price to earnings ratios, that means the higher the number, the more expensive. These are the sectors. Forecasted growth. I'm not going to read anything into this because I don't invest based on sectors. I invest what's called bottom up from the individual companies, but that's just there for your delectation, your interest, if you wish it. In the US markets, over the last 7 days and over the past year, my God, that's easy. It's ridiculous. When has this happened before? Well, around 2000. When you're as old as I am, you remember other parts of stock market history. And that's been pretty easy, okay, over the past year. Now, I happen to do not do this because this is for sophisticated investors only. I don't have 2 times leverage on NVIDIA, but I do have 2 times leverage exchange traded funds on Apple. Meta, as you know, I got out of because we're just too much in it. But had I not got out of it, I'd be happy to have held it, if you see what I mean. There was nothing wrong with it. It's just I need to rebalance my own portfolio because it had gone up some 500 odd bloody %. Amazon 2 times, and I've checked. My son and wife also. Tesla, I don't have 2 times leverage on. It's too volatile. We just have the single stock on that, as in no leverage. Okay. And we're going to go through these in a second. And I'm just disclosing what you already know, and I've been banging on. I reveal this every single week, twice a week sometimes for the last, God knows, 2 years, more. So there's nothing new there. And there are other stocks, and I'll come to those. But I think on exchange traded funds, I've really been under appreciating. Holding leverage, what does it mean? Oh, sorry, great question. So you can get a fund which, if Apple goes up 10%, your holding goes up 20%. If Apple falls 10%, you lose 20%. So when Apple goes up 25% this year, we made 50%, roughly, because it's a bit more complicated than that. In the case of Meta, you'd make double that. Amazon, we made 90%. Now you might say, you idiot, Alpesh, why did you not put all your money in Amazon? Yeah, you're right. In hindsight, I wish I just bought 3 times leverage Amazon and nothing else. Exchange traded funds are risky. They're dangerous. You should not do them, because I don't know who you are. But one thing I can guarantee is you should not do it. You might say, well, why not? It's good enough for you. The reason is I don't know who the hell you are. How can I possibly say it might be suitable for you? Because if Amazon drops 10%, you lose 20. If it drops 20, you lose 40. If it drops 30, you lose 60%. For all I know, you're the one guy who's going to go out and put his kids' future on it all. So I'm telling you, no, safer for me to say do not do it, but I'm just telling you. It's an exchange traded fund. It's a fund. It's bought just like any other stock. Okay. We can do a separate video on that. I've done it. If you look at my free education on my free investing course material, it's on there. I've gone into detail there, but I can always explain it a little bit later. Some of these questions I'll explain a little bit later. Yeah, Adi, I'd say experience, because it's leverage. I mean, if I said to you, if something drops 10%, you could lose 20. The most reasonable, responsible thing for me to say to you is, don't you please do it, when I don't know who you are, obviously. Okay. Price to earnings, this is the UK markets. Obviously, it's a bit cheaper for a reason. I mean, bloody hell, look at that. Profits down 37%. Total earnings in UK earnings are getting shafted. Okay, price to earnings, there's still some very expensive real estate. That's what we're good for. Forecasted growth, there is some growth forecasted in those sectors, but I'm not going to read anything too much into that at the moment. This is the UK market and what's done well over the past year. You can see a big difference. I mean, with the exception of Rolls-Royce, you can see a big difference between that and the US. Okay, we're not exactly, well, people aren't really clamoring to get into those, are they? Now, here's the exchange traded fund. So something I thought you might like. We get our data from all sorts of different places. I'll go into this a little bit later. So I've just put this up for my clients on the Great Investments Program. This is the performance of these exchange traded funds. So they're funds, just like stocks, they're funds. But they're not managed by active fund managers. So you're not paying the same level of fees. That's why I like the ETFs, they're called ETFs, Echo Tango Foxtrot. Okay, performance over the past month. These are some performance over the past year. Now, you can't just buy off the back of performance, obviously. But if you want to investigate further, those are the ticker symbols. There's some blockchain ones which have come up. I haven't done a detailed analysis for you on any of these, so please, this is just a starting point for you to look at it yourself. But anyway, for my clients, I think I did a investment note on DAP. And there was something else last night I put up on our private Telegram channel. I can't remember which one it was. It might have been DAGB. I think it was these two. I just did a note on those in terms of upside, downside risks, rewards. And just so you see, the problem isn't if something goes up. Everybody's happy. Nobody, yeah, life's easy if something goes up. The problem is the roller coaster to get to that. When do you know to hold and when do you know to exit? Okay. And the answer isn't, well, Alpesh can see in the future, so I'll just hold on no matter what. Obviously, that can't be the answer. The answer is you make sure you don't have the ones which are more volatile to the downside, okay? Because they're not suitable for your personality, right? Because you can always find something else instead, which is more palatable to you and will still give you your returns, all right? Anyway, markets year to date, S&P is up 26%, as you can see. The NASDAQ up 26%, the Dow 18. All right, so phenomenal year. Lots of periods with 0% returns. That's how it is with pensions. That's why we look at a 12-month period. With my stocks, I don't look at a one-day period or a 1 week or a 1 month, because you can have periods of 0% returns. Okay, zero. Look at that. That's zero. The markets can either rise. That's the first thing. They can fall. That's the second thing. That's not what you want. Okay. They can rise then fall. That's the third thing. Okay, and you don't really want that either because you've risen and fallen. Okay, or they go sideways and give you 0%. That's the fourth thing. Now, if you notice, only in one of those 4 occasions are you actually making money, when they're rising. The other 3 occasions, you're waiting. The classic example of this, which people just don't realize, and it's really important they understand. If I show you Microsoft in 2021, okay? Now, in 2021, in that period, Microsoft went up about 50%. Okay. It doesn't look like it, but if you were to look at that, and you can't see it, there are 9 months where it's either falling or getting a 0% return. And you might think, no, there aren't, go back and do it properly, and you'll see there are 9 months in aggregate where you're getting a 0% return. Okay. So for a hell of a lot of that time, you're getting next to 0% or 0% return. Okay. There's 4, there's 3, that's 7. Sorry, there's 4 and there's 4. That's 8 already, or 8.5 already. And then there were some falling months which overlap within that. Okay. And yet it generated 40%. So let me get this straight, Alpesh. It went up 50%, but 9 of the 12 months, it didn't generate a return. Exactly. And that's when, if you don't have perspective and you don't know to look at these things and you don't know what to look at, you look a gift horse in the mouth and you either get out too early or you wait on the sidelines. Your biggest problem isn't ending up with a losing stock. That's easy. You just exit if it drops 25% from entry. That's not your biggest problem. Your biggest problem is prematurely exiting a good company. Okay, because they're few and far between, and you still manage to F it up. That's part of my job, is to make sure you don't do that. And people think, oh, no, I won't do that. I won't do that. I won't do that. The number of people who in 2021 got out of Microsoft left that 50% on the table. They, oh, no, I won't do that. I promise. Now, these are the sectors. I'm not really going to go into these. Communications have done the best. Financials, utilities. That doesn't mean you should put more money into any particular sector, because I don't gamble on sectors. I look at the individual companies, as I've shown. So we'll go into some of those in a way. Okay. Similarly, these are the factors: momentum companies, value companies, growth. Guess what? We're always looking for value, growth, momentum. We want companies which tick all boxes. Remember those Venn diagrams from school? Yeah. We want the ones which are in the middle there. That's why we start with 10,000 companies and narrow it down to what's suitable for my son's junior ISA. If I wouldn't feed it to my son, I'm not going to feed it to you. Right? So it's a very simple way of avoiding a conflict of interest. If I wouldn't give it to him, and that's how I look at it, then I'm not going to give it to the public. Why would I tell you guys? My reputation on the line. Okay. Now, markets, 1 year. Nasdaq's up 32%, the S&P 31% as well. That's phenomenal. It's been a good year for the pension. Even if you made mistakes because you're new to investing, that will forgive a lot of mistakes within there. And if your pension went up by a third or more, well done, congratulations. If it went up with half of that, you should probably still be happy, because it means you've got a bit more to learn. But that was a good year. I didn't create that. It's not because I know which secret stock to buy. No, it's because the market went up. There was a tailwind. It's like if you're flying a plane from New York to London, same plane, same pilot, but if there's a tailwind, you get there a lot quicker. If there's a headwind, it takes longer. Same pilot, same plane. In other words, if there's a tailwind, we'll do better. If there's a headwind, we won't. Even though we've got the same strategy: value, growth, income, cash flow, Sortino. How come some years it does better than other years? Some years we have to hold cash. The plane doesn't take off. It's too turbulent, like 2022. How come, Alpesh? Same plane, same pilot. Why did it not fly? Because the markets were falling that year. So we held cash. We got 0%. So what's your average time to cross the Atlantic? Well, sometimes it takes 24 hours, because you have to wait till the next year, next day. Get it? Okay. That's what people don't understand. FTSE 350, biggest stock risers over the past month of these companies. Okay, I'm not really going to go into any of these today. On the UK ones, I'll go through some of the US ones in a moment. What I also want to show you is this: the big banks, and this is a new thing we're doing for our clients, our Great Investments Program clients, where we give them the data, but we also show them what the big banks in the past week have said in terms of buys. That's me and Slimmer Days. God, everything's bloody Slimmer Days. I used to lecture on this stuff at Oxford as well, at Corpus Christi. And I used to lecture on behavioral finance, the economics that I'm talking about, in 2001, 2002. And the reason was because it's where finance meets psychology that money's made. And there was some great research coming out of it, which I published in the FT and so on. So it was these banks. We'll look at some of these, but what we'll say is not just what they've said to buy. We'll then say, does it meet our filter: value, growth, income, cash flow, Sortino? That's what I care more about most, and that's the bit people miss. I don't care if JP Morgan says buy something, okay, because they could be wrong, right? Or Goldman Sachs says buy something to their richest clients. What I care about is, does it meet our filters as well? So let's take something like an Autodesk, which did meet our filters on value, growth, income, cash flow, Sortino, alpha, met all of those. It was an 8 out of 10. And on the momentum, okay, averages rising. Now, you might disagree with that projection. Is that a reasonable projection? And by the way, it was Citigroup on the 22nd of November said buy for that one. So did Morgan Stanley, by the way, on the 22nd of November with Autodesk. So is that one? Now, you might just, you just buy it. Well, wait a minute. No, because what you need to know is, first of all, are you okay with that level of volatility? 26% it can drop. Drawdown. Your due diligence is this. Remember this, DD. Due diligence, DD, equals drawdown danger. In other words, how much it can fall, peak to trough, because that determines your risk appetite. You can't take that. Trust me, when the bullets start flying and you're in the market and you're throwing up behind the sofa, right? Everybody's brave until the bullets start flying in the stock market. DD, drawdown danger, times duration to recover. Okay, so that period, which could be 4 months. So you've got to work out what's your drawdown. That is your personal risk profile. Okay, it is. And you might say, well, it's 25% or 15. Okay, whatever the number you think it is, knock off about 5% more because you're not as brave as you think you are. And duration for recovery. Okay, you might think it's 6 months. It probably won't be. Probably want to have 2/3 of that. So it'll be closer to 4 months. Okay, now, what does that mean? That means that if you say, Alpesh, actually, I'm a 15 and a 4, there's going to be fewer stocks for you to choose from. And that's fine. It just means it'll take harder to sift. That's all. Okay, if you're more like me and a, say, 25 and a 9, you've got more choice and you don't mind the volatility. I wouldn't suggest anybody go more than a 30. Okay, preferably stay below 25. Don't go below 15 because you won't find anything pretty much other than an ETF. If you're below 15, don't do individual stocks, do ETFs. Okay. And months to recovery. If it's less than 4, do ETFs. Okay, because they're the only ones who'll give you numbers less than that. Right? Simple rules. See, there's a lot of people who shouldn't be in individual stocks. They should be in exchange traded funds, not fund managers. That's different. Exchange traded funds are index trackers. They outperform fund managers because fund managers, the type that St. James's Place put you in, are shit. Okay, they're rubbish. The index trackers, they pay less fees. So St. James's Place won't put you in those because they don't earn enough fees. All right. Okay. I'll come back to some of those. Autodesk, yeah. But then again, as I said, Peter, valuation is not the only thing that moves stock prices. There are other things as well. And here's another really good rule. If in doubt, leave it out. So if for some reason you've got an additional metric beyond the metrics that I have, my metrics are based upon, again, those Nobel Prize winning economists. They're not always right. We get some stocks which don't rise. Okay. But if you don't like the number or what it is, if in doubt, leave it out. That's another mistake people make. And so you're absolutely right, Peter. What they do is they say, actually, I don't like the price to book ratio on this. But you know what? I'll do it because Alpesh mentioned it. No, if in doubt, leave it out. The price to book ratio is a perfectly legitimate, more conservative measure of valuation, which is perfectly fine. Because if you're more risk averse and more conservative, you shouldn't have this. But here's another thing, Peter. If you're going to be looking at price to book, you should already have discounted this because you shouldn't have liked the 26% drop. Because there's no man who's going to look at price to book and say, I can take 26% drops. Because then you'd be saying, I'm risk averse. I look at price to book because that's what Warren Buffett looks at. It's the more risk averse end of the spectrum of valuations. And then say, yeah, but I can take a 26% drop. That's irrational. And I'd pick up on that when we're talking to say, you wouldn't pick this anyway. Not because of the PB. You shouldn't have picked it up because of the reasons I said here on the falls. Okay. So that's really important you understand that. Now, I don't mind the slightly more volatility. But as I say, number one rule is if in doubt, leave it out. Don't just do it because I've mentioned it. Just because I say it meets my value, growth, income, cash flow, Sortino. There's no guarantee that everything that meets that goes up. I know there's no guarantee because if there was, then everything I touch would always turn guaranteed to gold. We know that doesn't happen with the stock market because Warren Buffett even has down years. Okay. We also look increasingly at the hedge fund ones. Which hedge funds are generating 40% per annum? And what stocks do they have? And then what we do, we use that just as a list of names. That's all. We're not saying that those stocks they have will go up. We're not saying that those are the ones they've just bought. We're not saying that they might still even hold them. We just start as a starting point of list of names, just as we could have picked names from a hat. And then we say, do they meet our criteria? So I'll give you an example. Here's a hedge fund manager who's got 4 billion under management and generates 53% per annum for the last 3 years. Okay. His average return is 53% per annum. It's Marshfield Associates. And 53% per annum is going to make you pretty rich, isn't it? That's the last 3 years. Might never do it again. No guarantee he's going to do it again. The past is not a guarantee of the future. So what stock does he have? Well, one of the stocks that he happens to have happens to be Visa. Doesn't mean it's going to keep going up. Get paid the big bucks for picking Visa. Bloody hell, I've got that in front of me on my desk. Anyway, okay, now that's the projection. If it continues on a broad general trend in that direction. You might disagree with that projection. You might disagree that that can happen. If in doubt, leave it out. There's an 8% to the downside. You might say, well, you could put a stop loss there. Can you get a multiple upside to downside? That's the first thing. Secondly, and by the way, it met our criteria, value, growth, income. Didn't meet our momentum, so it's not a special situation. A special situation is where it meets that and the momentum. Didn't meet our momentum criteria, so it'd be outside of our program, as it were. Do we get multiple upside to downside? Do we think the upside's clear? Do we think the downside is such that we would know pretty quickly that it isn't going to go to the upside if it goes to that downside? And then the amount of money you put in is if you did lose and got out there, you shouldn't lose more than 1% of your total capital. Okay. Staz, I'll answer your question as well. So that's Visa on an 8. Now, again, if you're more on the risk averse side, you say, I'm not going anywhere near this. And I'll give you several reasons why. You'll say, well, I don't like any stock which, for instance, has less than a 50% chance of going up on any given month in the last 10 years. Okay. This only goes up 40% of the time in June. You might say, I don't want it. You might say, I don't want it because I just don't think Visa's going to go up like that. I think it's an old story. I just can't see how that goes up another 40%. What the hell's going to happen for it to do that? You just might not see the story. And we're not based ours on narrative. What we're saying is the data suggests we're okay. So that's us. You might disagree. Okay. In which case, if in doubt, leave it out. You should never own something. And Warren Buffett said this. I'm not saying anything novel and I'm not copying him, but he said, unless it's very compelling for you, why the hell are you in it? He didn't quite put it as inelegantly as that. S&P 500, this is where we are at the moment. Now, something very important going on in the markets and something that I've not seen since 2000, so in the last 25 years. So when I used to do the Bloomberg TV show on Tuesdays and Wednesdays from the studios, that was the last time I saw what I'm seeing now. Okay, and what I'm seeing now is this. See this? That's pretty overbought. And it was here, and I've said this time and time again. I've been like a broken record saying this for so long. It's overbought. And the danger is it can fall. And if it falls, it does this and drops. Okay, in which case you want to be holding cash. Whenever this is falling, I do not want to be in the market, right? What I mean is when it's falling below its own moving average, which is the yellow there, right? I don't want to be in the market. And this is when I do these webinars twice a week and I explain all this, right? And I've mentioned it in my books, and it's I didn't invent this. It just seems to work a lot better than trying to read the narrative and see what the tea leaves are saying. Okay. At the moment, what's happening, not just with the S&P, but with a hell of a lot of stocks like Nvidia and a whole bunch of others, is this is just going up and up and up. Now, that's a very bullish case. It's not guaranteed to keep going up if it makes you uncomfortable, i.e. if you are risk averse, you should, of course, be in cash. If you're risk averse, you shouldn't be in stocks anyway. Okay? Now, would I buy the S&P 500 tracker if I didn't already own it? Because I do own it. Yes. Would I buy 3 times leverage S&P if I didn't already own it? Yes. Should you do 3 times leverage? Hell no. I've got 2 private jets and a helicopter in my back garden. You haven't. Why would you do 3 times leverage? I don't, but you get the point. You don't copy somebody else because that's insane. That's like saying Alpesh plays Russian roulette. I'll play Russian roulette. No, what's suitable for one person isn't for you. I don't have a problem doing 3 times leverage on that. I don't think I'll make 100% next year on it, and it might be that if it does this, I'll exit. But what I'm saying at the moment is we're seeing a lot of this now. I'll tell you why that's really interesting, and probably the most interesting thing I'm going to say to you this evening. The reason that's really interesting and why there's a lot of money to be made in pensions, potentially, but never guaranteed, it's never bloody guaranteed, sadly, potentially, is it's the opposite of what was happening here when the markets were falling. It wasn't just the S&P, but it was Apple, Microsoft, all the big companies were showing this pattern. And when they do it in congruence, when they do it together, they're amplifying each other. Because you look around, and what happened? Everybody, well, I got into cash, not everybody, they all fell simultaneously. Okay, because you look at this, you go, oh, Apple's falling, Microsoft, oh, let's get out. Here, what's happening is everything's bloody rising. That's not to say one day it's not going to fall. Look at this. It can keep rising, rising, rising. Of course, it's going to bloody fall one day, but I'm not handcuffed to it. Okay, so whilst I will have eternal vigilance that the Russians are coming any time to knock down the door and drag me away, while the sun is shining, this part, and that's why I do weekly broadcasts, not once a bloody year, once every 10 years, okay, is just say, listen, guys, I'm still watching. I'm the lighthouse watchman. And the guy who's saying, okay, no, it's all fine. Because once in 7 years, you're going to be glad the lighthouse is on. That's all. That's all I'm saying. So at the moment, I'm pretty happy. But yeah, I give that same caveat I've given every single week. I don't do dumbass, woohoo, I'm not going to go ecstatic ever because I know what the market's capable of. Now, if we get falls like this, which you get called baby bears 3 times a year, 3 or 4 times a year, and the average price is still rising, I'm not worried. If you get deeper falls like this and the average is falling, as long as it doesn't fall below its own moving average, I'm not worried. Got it? Simple. So I'm relaxed. Usually I'm relaxed. Same with the NASDAQ. Index tracker, yes, tick. Leverage, fine for me, tick. Are we making stupid sums at the moment? Yeah. Will that last forever? No, of course it won't. There'll be a period where I'm making nothing. There'll be a year guaranteed where I'm making nothing. Because those years happen. What am I going to do in the falling years? Now you might say, well, why don't you do an inverse? Well, it's not our strong point. We can, but I don't like it. So during this year, whilst we do trading, which is separate, so ignore that. I don't invest in inverse ETFs, which profit when markets fall. It's just not my thing. Mentally, psychologically, just doesn't suit my persona. Okay, FTSE 100, where are we? Sideways on that, but I am very optimistic on the US ones. So let's look at what's gone up over the past month and see if there's any opportunities in these, just names that have come up. In the past month, Tesla's gone up. I've given the Tesla note already. We got into it after the election on, actually it's a month now. When was the election? 4th of November. God, I'm forgetting. Shit, when was the election? Anyway, it was around there. So it's been a month, I think, now. So we got in after. Why didn't you get in before? Well, because I don't have a time machine. And whilst I thought Trump would win, as I've said several times, I didn't think it was going to be that emphatic. Nope, I got that wrong, that he was going to win that clearly. I did not think he was going to win the House and the Senate. Nope, got that wrong. I didn't think he was going to win by 4 a.m. the day after the election. Nope, got that wrong. Okay. The only thing I got right was, yeah, Trump will win, not this emphatically. That changed everything. So yeah, we got into that then. And now you might say, in hindsight, you idiot, why did you not just mortgage your house and sell the private jets and just put it all in that leveraged? Yeah, 10 times leveraged on that would have been up 400%. Not what I would do. I've got a 6-year-old son. My number one job, as my wife points out, is not to F it up. Okay. Stas, brilliant question. I'm going to answer that as well. Yeah, 4th to 5th November. I thought it was then, wasn't it? Yeah, thank you for pointing that out. Yeah, my brain is going. Axon Enterprises. So what we're looking at that. Oh yeah, here it is. It was that one. Okay, well, it's not one of our 789s. It's not a special situation, and it's overbought. Now, I know the banks all love it. I mean, not the banks, sorry. Yeah, the banks. Morgan Stanley said a buy note. But that isn't fitting our profile at the moment. So the only way we would look at this, and we're not, is, well, it doesn't hit 789. It's overbought. The only way we'd look at it is say, well, that's the projection. If this continues, the stop loss would have to be somewhere down here. So you know pretty quickly if you're wrong, because if it's going to go in this direction, it shouldn't go there. So you've got a tight stop, so you don't have to lose much money if it drops, and you've got multiple upside to downside if you want to take that. It's not one we're going to do. All right. Super micro, which is all Bitcoin, obviously. I'm not going to do something which is like this, where that's falling. I know it's gone up a lot, 54%. It's not one for me at the moment. If you did want to structure this trade, that's your upside projection, which is based on historic, right? And some of you will agree it's 251% in 12 months. Okay, and your stop loss, if it's going to go up there, the way you work out your stop loss is this. Now, listen to this. And by the way, JP Morgan said sell after the election. Goldman Sachs have only said hold, so they're not even excited. Okay, your stop loss would probably be somewhere here, because this is how you work out a stop loss. If that's how much you can make, then how do you know when you're wrong? Well, if it goes there, then you're not. You might go, no, you could still be right because it could drop all the way down here. Yeah, but do you really want to do that? Obviously not. What's the nearest point to there where you've got, on balance of probabilities, you know that it's not going to keep going up? Okay, there's the Tesla one and what we're expecting even from now, 139 going up. It's not a 7, 8, or 9 at the moment. It was, I think, earlier in the, but it doesn't matter. And there you probably put the stop loss there, or maybe here, or maybe here, or if you're really risk averse there. The point B, I mean, I don't think you put it there because you're taking a massive loss before you say I'll exit. And look how volatile it is. This is why you don't bet the farm on it. It's a bit like poker. You're having to put down 42% of a downturn before you even know time to get the hell out. So 42% is too much. You really want to say, if it drops to this, well, maybe down to here, then you know that this isn't happening. At the moment, we're more than happy to be long on this, long on Elon. Okay. Costco was one of the other movers, I think, wasn't it? Where did we get Costco from? Not sure where I got Costco from then. Oh, just stock market update. Just doing a regular stock market update now. Okay. So Costco is one we always like to keep an eye on. It's not one we're in at the moment. That's the projection there. Your stop loss would go there on the basis this is going to continue. Notice what I said. A lot of these momentums are not moving lower. They just keep going up. And Nvidia did that. This is doing it. The S&P is doing it. It means that the market is relying more on momentum, which is dangerous, but that's why you're going to look at this monthly. Now, if you do not like 35% drops, you shouldn't be in an individual stock. Okay, we're not in this, and I'm not planning to buy any at the moment. Okay, because I've got enough other choices. Bank of America, just a stock market update now, regular stock market update. As you know, it's one I've been following and telling you about for over a year. And in that period, yeah, I probably do regret not buying because it's up 50%. Those are the projections. That's what we'd continue expecting. Netflix, again, not one I own, but I've been talking about it for ages and probably do regret not having bought it because it's up over 100%. But I can't buy everything. And it's now a 7. It's overbought, but like some of the others, it continues. Now, if you're looking for a narrative on this, maybe the narrative is Competition Commission. They're going to get rid of Miss Khan, who is the FTC chairwoman in the United States and very sort of antitrust. And American firms are going to be able to acquire each other more readily. And that's why a lot of the communications companies, entertainment companies have been skyrocketing. There's a narrative. I don't care about the narrative. I can make any narrative fit my beliefs of what I want to believe. I prefer data. And this is a 789 tick. It's overbought, so there's the risk on it. And you'd probably want to put a stop somewhere around there. Okay, Walt Disney 8. It's back to where it wasn't it. You don't want to be doing this because most of you would have a heart attack at a 29% drop because it's too volatile. Drops 29, then rises back again. Okay, don't do it. Do not do this. And I'll tell you why. It's that reason. It's not your price to books. It's not your other things you're looking for in the fundamentals. It's in front of your bloody face. It's the 29% drop. Okay. Why does that drop exist? Because those fundamentals somewhere had something which wasn't tight, wasn't screwed in properly. Okay. Now I don't mind that because I can take roller coaster rides. Others can't because I'm old and haggard. Used to it. Okay, so there's your Walt Disney. It's now at 116, which is pretty much the highest it's been since 2022. Fine. All right. Block 7. You don't want to be doing block. I'll tell you why I don't want to do it because it's going to drop 48% before it rises and goes up. So you don't want to do it. That's how you know. People are there looking at, well, I've got to see what this journalist says. Screw journalists. They're the reason there are journalists and not hedge fund managers. Okay, forget them. That's the reason you want to know, not to do it. Okay, so it's a 7, but it's not for you because that's not what my people want. All right, they can't take that volatility. They think they can. The bullets start firing. They're hiding behind the sofa and shivering. Right. This I'll leave for the Great Investments Program, Amazon as well, Microsoft as well, Meta for my full-time members, all of these, Eli Lilly, I'll discover that. Now, this is the thing. That's the S&P. Sorry, that's the NASDAQ. NASDAQ is 600% up since 2009. The S&P is up 300 since then. The UK is up 47. That gap is going to increase. If you do not appreciate this gap is going to increase between the US and the UK, then you're screwed on your pension. This is why the St. James's Place person will not do what you tell them. They will refuse to do what you tell them because they don't get the kickback commissions. Okay? They won't tell you that's the reason. It is the bloody reason. And don't forget, they sit their exams on a multiple choice where you've got 5 choices and you only need to get 3/4 of the answers right. You do the maths. It's pretty bloody difficult to fail that exam. Biggest funds in the doghouse. See this relative performance? St. James's Place, 27% down. Fidelity, 91. Fidelity, Bailey Gifford. Go call your workplace and ask them, have you put me in anything produced by Jupiter, St. James's Place, Lion Trust, Bailey Gifford, Fidelity, 91? If they have, you're screwed. Good luck working till 100 years old. I hope you've got lots of children to look after you, because this is what pisses me off about the UK pensions industry. They are ripping people off. They're lobbying parliamentarians at the moment to get even more cash. What they're saying is, hey, you know all these local authorities, can we have their cash to invest in British companies? Okay, well, actually, I'm British. I spend my money in Britain. I want to own the best assets around the world and bring that money back here and spend it here. I want those. I'd rather have an Apple growing in America, bringing the money back here, better for balance of payments as well, and have more money and not fall on the state. These buggers are going to guarantee you're all going to fall on the state and rely on your state pension. I'm exaggerating to an extreme point. I'm sure some of you have got palatial homes you'll be able to sell off, but that's what's buggering things up. And our pensions industry is destroying UK pensioners. Why? Because they earn more money by charging you fees with active fund managers who invest in home market. It is stupid. And if you think, oh, surely the politicians are caught up on it, seriously, they hire Elon Musk. We hire, who was Boris Johnson's special advisor who had to drive around that castle because he couldn't see? For flipping sake. Now, why is all of this important? Time it takes to double your money, rate of return. If, as St. James's Place will want to get you, 5% per annum, it'll take 14 years to double your money. They'll want to just do a bit better than a bank account. And British people are so beaten down by this, they actually think getting a bit better than a bank account's good. What they're thinking is, I'll put it in a bank account and I'll look at Money Saving Expert, who will give me another 1%. Laughing. 14 years, I'll double money. Guess how quickly the frickin' Americans do it? Well, that's the S&P double-digit returns. That's the Americans. 4.5 years. I'm not greedy. I don't care if it, if I can get 20% and it takes 3.8 years, okay, I'm not bothered whether it takes 3.8 or 4.4. But I want to be in this part of the market where it takes that long to double my money. And that's just a bloody index tracker. Forget leverage. Okay, just an index tracker. Not even told you a single stock then. But there's another reason why I think it's feasible. There's no guarantee the markets will continue doing what they've done in the past. But I reckon over the next 2 years, I'm going to get 32%. I think one of those years will probably be 0%. And one of those years is going to be 32. Why? Because statistically, 88.5% of the time, that's just what the index delivers anyway. As long as I don't F it up, I should just be flying with the tide, floating with the tide. Okay, average positive return 32% over 2 years in the S&P since 1950, and we've seen that happen time and again. One of those years will probably be 0%. So my pension should go up that. Well, it won't. It should do bloody better. for the reason I've already explained. I'm going to answer your questions in just as Dominic Cummings. That's it. They get Elon Musk. We get Dominic frickin' Cummings. He walks in with his Tesco carrier bag to number 10. They got a guy who puts rockets into space and lands them on a pair of chopsticks. We get a guy who walks around with a bloody Tesco carrier bag. Doesn't mean our guy's worse. Well, it does actually. Testimonial. This is my job. This is why I do it. This is why I do webinars. 12 months, I've seen a 30% increase in my portfolio. I have a campaign. It's called the Campaign for a Million, to teach 1 million people through social media. We're on TikTok right now, on YouTube, how to add an extra million across their lifetimes into their pensions. I'm not adding that million in. The companies that I've discussed will add that in for you. That's $1 trillion. If I can leave a legacy of adding $1 trillion, because it'll go on after I die, just like my books will. Some people, they'll have learned and they'll be continuing when the last person leaves the room. If we can get to 1 million people, now we're at 500,000 subscribers on TikTok. Doesn't mean they're all following all of this, but you get the idea. These numbers can make sense. Have a look at that if you want to see videos. These are actually all videos of clients and what they think and how they found stuff. So have a look at the videos on there. Still got a bit more to go. Those who find it difficult to understand everything that I've said, look, it's really simple. It doesn't have to be Barclays. It's not an advert. I'm not promoting Barclays. To open a SIP is like opening a bank account. A SIP or an ISA, they're just tax-free accounts. Okay, very simple. Okay, I'm going to answer your questions, Stas, and others in just 1 second. Has your pension lost a fifth of its value this year? That's from the Daily Mail. Workers actively choose funds they are put in one-size-fits-all pension. I didn't write that. Okay, Daily Mail, 2022. They're put in one-size-fits-all pensions. They're screwed. They lost a fifth of value in 2022. Okay, or as in the Financial Times, give workers power to ditch pension schemes. I didn't write that. If you think for a moment I'm saying all this about pensions and fund managers because I just got a gripe, I had an ex-girlfriend who was a pension fund manager, which I didn't, then you're wrong. I'm saying it because I'm repeating what I've seen on the data and how bad it is. UK regulator calls, and it's the one area I can lobby on. It's the one area I can talk about with some degree of expertise. That's why. Pensions, why do those retiring face massive losses despite FTSE highs? That's the Guardian, for God's sake. Retired planner was shocked to see Aviva pension drop 20% in value. Yep. Have British fund managers become a pointless expense for investors? That's the Telegraph. So you got the Guardian on one side, Telegraph on the other, DIY savers. Worst fund managers take $500 million in fees. It is a massive scandal. But because it's not fraud, and they're getting away with it so nicely, I don't know anybody else other than myself in the UK and Eugene Famer in the US. And Famer got the Nobel Prize in Economics. I'm not clever enough to get the Nobel Prize in Economics. I'm echoing what he's discovered. Nobody else says how crap they are. Okay, so if you do nothing else, get an index tracker and just look at what I said about moving average prices. Okay. Good morning, Ash. I've been on the course for most of the year. I'm finding it very interesting, to say the least. My career has been in engineering for 40 years. I've been following you twice weekly stock market updates. Been blown away with the information you've provided recently. Being able to check my own pension with Legal and General, provided by my employer. The information was shocking. 20% growth between 2012 and 2022. Yeah, it's Legal and General. You trust them, don't you? Because they're a big name and they advertise on telly, so you must trust them. 20%, not per annum, in 10 years. As you can imagine, I've now taken steps to remove this and control the funds myself. Currently, I can get 5% interest at least anyway. As I said earlier, I've been following your weekly report and I've invested very limited funds, but I've seen returns of 20% this year. I want him to be educated. I want them to be empowered and educated because it's the one legacy I can leave. I'm a teetotal vegetarian. I don't need more money because what the hell am I going to spend it on? Bloody steaks? No, I'm teetotal and a vegetarian. Expensive wine? No. I don't like cars. Actually, I bloody hate cars. I ride around in a Lime bike. Okay, I love Lime bikes. Based on growth percentages, right, for that person in a 10-year, if he had 100,000 and he just did an index tracker on the NASDAQ, he would have got 382%. Now I want to do more than that because I go beyond that, resulting in a final value of 482,000. If he just did the S&P, he would have got that much. Instead, he got 20%. Even an index tracker there would have got 25%. That's Legal and General. Speaks for itself. Time and time again. They're getting screwed. Do follow me on LinkedIn. I am what they call a top voice. Okay. It's one of those. It's probably, if ever you see somebody on social media, due diligence them on LinkedIn, because on LinkedIn you can see who their connections are. And because everybody else sees them, you can't just fake it on LinkedIn. So have a look at my LinkedIn. You'll see what I do and my articles and everything else. Follow me on there. Nick Train apologized for poor investment performance. UK fund manager blames lack of exposure to tech. No shit. Guess how much he gets paid? And fossil fuel stocks, as well as broader malaise in UK market. Well, he's right about the malaise in the market. So you might say, well, why is he buying UK stocks? Because he's forced to by his employer, the fund management company he works for. And the newspapers build him up. Okay, and then he has to apologize. In a way, it's almost not his fault, except it is. He was disingenuous, not telling people, don't put money in my fund. But who's going to ever say that? When you're getting paid $1 million a year, you're not going to turn around and say, don't give me the money. You too would be corrupt and say, yeah, Scottish Mortgage Investment Trust. Ask them, ask your IFA, ask your wealth manager, how did you do in 2022? How come you didn't tell me to hold cash? And watch what they say and then message me. The amount of bullshit they say and wriggle they come up with. How come they didn't? Listen, this isn't new for me. Okay, 25 years. I've been switching virtually all of my long-term holdings from UK into US stocks. Alpesh Financial Times, 1999. 9/11, 1999. There's the article. That's me with the hair. Okay. This is September 2024. Financial Times. To the day, right? 25 years later, UK pension fund allocations to British stocks hit historic low. Took 25 freaking years for them to say, maybe we should look after our customers, which is you. 25 years. Now, credit to the FT. When I wrote that, they didn't say to me, don't write it. Okay. But they didn't have a campaign to tell people, get the flipping heck, I won't swear, out of these things. Okay. Jets and a helicopter and a quarter of your pension gone in 1 year. Blue whale. This idiot behind that is being advertised on social media. I've forgotten his name. Whoever the fund manager behind Blue Whale is. Oh, his top 10 picks for next year. I don't give a damn, mate, what your top picks are for next year. Why don't you explain why you lost a quarter of people's pension in 2022? Keep quiet about that, won't you? That's what's going on, because they won't ever tell you to hold cash. Now, we had a great year in 2020-21. We had 0% in 2022. 2023, we had an amazing year, which I'll show you in a second. 2024 was amazing because the markets were amazing. Did I know Crocs then was going to go up in that 12? We hold for 12 months and then reevaluate everything on the database. No, I didn't know it was going to go up 208%. Otherwise, I would have gone to Ladbrokes and said that. Generac, we're in it. If Crocs and Generac went up 137, Costamer 135, Camtex 120, how come you only made 54? Because there were some which did less than 54. Well, why did you not just pick Crocs? It's not physics. We pick from things which tick the box, but how they perform. That's why you don't have just one stock. When do you sell? 12 months and reevaluate, drop 25% from the high point or from entry. Have a look at alpeshpatel if you want to see the videos with people. So it's 40% realistic. Well, it is if there's a tailwind like in 2021, 2023, and I should put 2024 now that I know we've definitely got that tailwind. If you do the value growth income. So this was 2023. If you want to see 2020, 21, 22, 23, 24, have a look at the website, alpeshpatel.com/shares. Okay. Now, did I know NVIDIA was going to go up that much last year? No. Or Meta? No. They ticked the boxes, but I had no idea that they were going to do this. They just were in our list. Okay. I don't own, but I'm okay with buying ServiceNow, by the way, at the moment. I don't own it, but I'm okay with it. Okay. There was a tailwind. So we did ridiculously well. This is the Croaky bit from Goldman Sachs, by the way. Croaky, cash return on capital invested. It's the cash that comes from the capital. So imagine you buy a machine and the machine produces sweets and you sell the sweets. That's the cash. The machine is the capital. If you've got a high amount of cash coming from the capital, i.e. you've got the license to print money, then your company is going to go up more. That's all this measures, cash cows. Croaky could be called cash cow. It took their Goldman Research quantum database department, and I was impressed when I saw this. 30%. That's why I need that box ticked. That's all I'm reading from it. Tick that box. I'm not reading from it, this is guaranteed to work. I'm not reading from it, it'll always work forever. I'm not reading from it, only look at this and nothing else. All I'm reading from it is, I want that Croaky box ticked. That's all. Companies in the top 25% by cash return on capital invested. Those are the ones which are cash cows. Okay. Bernard is the chairman of a multi-billion-dollar hedge fund. That's his endorsement. That's Merrill Lynch. This is BBC, Philip. That's Coutts Wealth Management. That's Financial Times columnist. So my peers get it. Okay, they get it. We've started doing this for fun. I did this last year, and I might for 2024 do a collection of these. This is for fun, so don't read too much into it. We asked AI, and it came up with Broadcom, and it was one we'd missed, in the sense that we had a whole load of list of stocks, and you can't go through every one. But we asked AI, and then AI picked it, and we said, well, let's cover it. And we covered it and generated 83%. But anyway, that's more for fun, so I'm not going to go into it now. But I'll go. There's an article. There's a couple of interviews with Business Insider magazine. You can see on the internet. If you put in Alpesh Patel, Business Insider, it goes into the algorithms that we used and how we got to those AI picks and how they performed over a period of time. So they did a few interviews with me over a period of time. So did Yahoo, actually. So if you look at Yahoo, we did a sit-down interview on how we did it, and then they came back to it and said, well, how's it done? And it blew the doors off. But again, too little time frame. It was done for fun. Yeah, wasn't done under academic circumstances. Okay, which I might do in future. I have been to the maths department at my alma mater, and it might be that I get somebody to do that, but at the moment I'm not too concerned. That's the holy grail for me. Okay, that's the holy grail for me. Okay, I get it to do all the work. We have a data team who collects all the data, and then we have a graphics team who puts the charts together for me. The whole point is the graphics and data team work for me, or they work for my clients on the Great Investments Program. 55% was 2021. You can have a look at this. 80 was, yeah, there's been some great tailwinds. It doesn't mean they'll continue. Have a look at householdrareviews.com. If we improve somebody's pension once by just 20% more than they could have got themselves, then $500,000, that's 100K they make. If they never make anything more than just the standard amount they would have otherwise got after that, they've still risen, and then they're growing at, they've elevated and they do the same. If we get more than 10% more, if they can, with our help, get a 10% uplift on their pension, that's how they work out whether or not it's a no-brainer or not. Okay, if you want to download a free copy of this book, I'm going to put the files, I'm going to make that available as well. Okay, so sorry, I know it's getting quite late. It's 10 o'clock. Sorry, apologies. Okay. For those who want to be part of the program, I'm going to answer your questions now, and access to the Excel and this, you can do that. I take people on. What I want to do is float a company. The company I want to float is an asset management company which doesn't own the assets. You own the assets, but because you have access to the data and the know-how, we give you the know-how in one-to-one tutorials and the hand-holding. We think we can steal all of St. James's Place clients and become a FTSE 100 company, because they're a FTSE 100 company. If you want Paresh to give you an explanation or a tour of that, alpeshpatel.com/links, and he'll do that. He launched in 1999 a hedge fund, Marble Bar, developed strategies for it. He was he wasn't the only founder. It was one of the team of founders on that. He was in charge of the strategies back in 99. 2012, he co-authored a load of books. That's how I know him. I know him from the hedge fund industry. He can give you a tour of what we're doing as well. If you don't want to wait for the tour and you want to sign up, you can do that. What I want to do is get 350 people on there, and then eventually prove to venture capitalists this works, and then a few years after getting venture capital investment, float it. That's the ambition, and hopefully make it into a multi-billion-dollar asset management company. The way Airbnb doesn't own apartments, Uber doesn't own cars, I want an asset management company that doesn't own assets. You hold the assets, and there's no ongoing fees. We want to keep it just one-off. So it completely avoids the conflict of interest that when the markets fall, we can say to you, no, hold cash, because we're not earning off your performance. We're not earning off that. We're educating and giving you the information. We're not managing your money or controlling it. You should control your money, because here's something that you might not know. You care more about your money than anybody else does. Okay, so you can do that, and don't forget alpeshpatel.com/links. Okay, as well. One of the things that we're going to do, I'm going to share the book with you and a whole bunch of other stuff if you're on the webinar. Okay, one of the very important things that I want to say is we're going to be putting the price up again. I mean, it's been a year where the Nasdaq and the S&P is up 33%, and Paresh thinks we should therefore raise the price by 33%, index tracking the price. So that's what we're looking at the moment, to put the price up 33% by the end of the year in that. Okay. Any questions? I'm going to answer them now. Where are your questions? I want to look at the questions. Here we go. Sushila, did Alpesh answer your question about JD.com late to the webinar? Sorry, no, because I've answered the questions now. What's the price of your program today, Alpesh, with 40% discount? No, Stas, it's not 16. Have a look there. It is, I'll show you exactly what it is. With the webinar discount. This is on the webinar, okay? It is either the one-off, it's there, and it's 24 payments there, or one-off, including VAT. If you're in the UK, you've got to pay VAT. If you're not, you don't have that tariff. They complain about Trump having a tariff. What the hell do you think VAT is? It's a tariff. It's a tariff on all British people. Okay, if you're European, you don't have to pay that VAT. If you're American, you don't. Well, if you're European, you might have a slightly lower rate, but if you're American, you don't have to pay any of that. Okay, and that's the discount. But that's only for the webinar, and it's only for the first 10. So that's what it is, Stas. And it's going up again. Okay, but you can do installments. Now, where's the questions? Alan Jetson, helicopter, thank you for sharing the experience, expertise. And another question, Alpesh, what if individual stock cross signal line down, but he's not down 20%? Do you still hold or sell Microsoft? Is a good example. Stas, I'm going to do Microsoft for the clients later. Basically, only for what I call my quality 5+ do I apply, and indices, do you apply the MACD rule. MACD rule doesn't apply to individual stocks unless they're one of the quality 5+. And Microsoft hasn't deeply crossed through yet, so I'm still holding on to my Microsoft now. Dominic, how do we feel about Coca-Cola price roller coaster at the moment? I'll have a look at it tonight when I do the client stock market update. It has been a bit of a roller coaster volatility, but I'll have a proper look at it and I'll do a video on that. Stock tends to go up like ETFs in line with earnings. Do stocks go up in line with earnings? Over the long term, yes. Over the short to medium term, not necessarily. Over the short to medium term, they follow a random pattern. Over the longer term, yes, you're absolutely 100% correct. Earnings is a critical factor, probably the most critical factor. Over the very long term, the only factor that matters is earnings. So you're absolutely correct on that. On the night for as Nasdaq and SP look a bit of what would you be better buying croaky stocks instead? No, Stas. You really want to look at the volatility of the individual things. So if you look at, say, the S&P and the drawdowns, they tend to be shallower than individual stocks as a general rule. So yeah, I'd say as a general rule, no. Funds like the S&P, which is a fund, tends to be a lot narrower. Okay. On that, whoops, I'm gonna just go through some of this stuff backwards. What strategies do you use on the map? What settings do you use? So I've covered this in one of my books from about 25 years ago. We played around with a whole variety of settings. And what we found is if we changed any of them, we were just curve fitting. So the default ones you get, which is generally tends to be, what is it, 26, 12, 26, 9. Okay. It's a difference between the 26 period and the 12 period moving averages, and the signal line is the 9 period moving average of that. I can do a separate webinar on what these things mean. So the default ones are fine, because whenever you move those, you curve fitted the data. I only did statistics to A level, but I did get the maths prize at school, and I can tell you curve fitting is a major problem, and it's why clever people fool themselves into thinking that there's a causation when it's just coincidence. But prepare to sell on 2nd Jan. You may well be right. That's why we keep doing the webinars. We don't know. You see, if somebody says to you, nah, it's going to go up, you'll be fine, with any degree of confidence, then there's something wrong with them at any point with anything to do with the stock market, because they should be humble enough to know anything can happen, but like walking through a room in the dark, things look okay. Another question I was, what if individual stock? Oh, you answered that. What settings do you use? Hi Alpesh, what if average drawdown is 25%? So I'll wait till drop 10 to get in so I can minimize risk. Staz, email me. I'm not quite sure what you mean by that. Totally agree with drop. When you use leverage ETFs, do you still use the 25% rule? Do you use the 50% example? I look at the underlying. So if the underlying has an exit, and let's say Microsoft, I got 2 times leverage on Microsoft, I'd want that to be forming a daddy bear, basically. You're not doing leverage on the 25% rule, really. What you're doing is the kind of securities you can use the MACD mummy bear, daddy bear rule on. Otherwise, you wouldn't do leverage on it. And this is the mistake people make. They start doing leverage on things like Tesla. It's like, you insane? You're gambling. Okay. It's more for experience. What does hold? Yeah, leverage. If you see a daddy bear, would you tweet it in case for some reason we miss it? Mark, on Telegram, I don't tweet it. Twitter's a bit rubbish in terms of getting any engagement from me, I'm afraid. So what I tend to do is I put it on my Telegram channel. If you want to be on the Telegram channel, it's alpeshpatel.com/links. Okay, that's where I'm on that. Ruth, we still have cash in 2026, thinking about their CBDC's push and BRICS momentum. Thanks. Ruth, I'd have to look into that. What about GEPQ? Ask Dwayne. GEPQ. NASDAQ equity premium one. I've not looked at it in detail for Sortinos and Alphas. All I'd say to you is, like so many, a bit overbought at the moment. If that trend continues, you should be fine. Okay, but I've not looked at it in Sortinos and Alphas. Looks reasonable, I think, by the looks of it. By the way, there's a lot of free resources on alpeshpatel.com/shares. If you go here, you will see that how 2023 turned out. So we're going to detail on 2023. And also you will see a whole bunch of stuff. Can you manage your own pension? Should you transfer from your existing IFA? What returns we're aiming for? Cleaning up your portfolio mess you have. So this is really useful. It's alpeshpatel.com/shares if you haven't, and that's free previews. You can just see that for free on there. Okay. I will send you an email. Those who've signed up, I will send you an email as soon for onboarding, and then we'll have our first call as well. What are the main indicators you use to monitor graphs and over what time frame? On the technical analysis, the MACD, and you've seen the charts, and you want to see more of them, they're on Telegram, the ones I've shown in this video. That's the time frame. I look over those last few years, at least last 4 or 5 years. What are the main indicators you use? Oh no, I've done that. Is there a webinar on ETFs? That's the one I'll do. Any comment on using Buffett metric of time until payback? I'm not familiar with that one. How about using inverse ETFs instead of cash? Yeah, I think I just discussed that, but I didn't really see your question, but it tends not to be me so much. Late apologies, was at the pub. No worries, James. Is JD.com worth holding on to, or should I cut my losses and exit? Now, here's a good question. Let's have a look at JD.com. When you get the more volatile stuff like this, there's a couple of things. One is, okay, let's look at something like a JD. Oh, sorry, where are we? We're all the way over here, aren't we? Okay, let's look at something like a JD. Now, this is a bit like Alibaba and the other Chinese companies. On this, moving in this direction, we know it's already volatile. So if I get a client who says to me, oh, but I got into this, but look, it's dropped, a bit, then the first thing I say to them is, well, now you know your risk appetite. Don't ever do something which historically has dropped 31% or even 25%. How do I know you shouldn't do this? Because you're asking the question. If you're asking the question, it doesn't matter that Citigroup said buy on the 15th of November, okay, or Barclays on the 16th of October, or JP Morgan on the 16th of October said to buy it, or JP Morgan on the 16th of August. None of that matters. What matters is this is not suitable for your risk appetite. So now you've got a decision. Okay, I've got a mess, Alpesh. I've got into something which I saw was volatile and I still got in, and now the bullets are flying. and I'm not happy. What should I do? That's a separate issue of what to do. Now, I can actually do a stock note on this actually, but let me just explain what that stock note will do. It'll probably cover and say, worst case downside is probably going to be another fall 40% all the way down there. I doubt it's going to go that low. I doubt it'll even go here. Might probably fall to about here, not least because this is rising. Okay. And some of this has happened because of tariffs and all that scaredy-wordy stuff. And by January, people will realize that a lot of it was just bluff and bluster. Okay. Now, I'm not saying it's necessarily going to do this 128, but that's your max potential upside, I suspect, over 12 months. And your downside's probably potentially even more. So rule number one, don't do it again, because you now know your risk appetite and it isn't a JD.com. Rule number two, I'm comfortable with it. And those are the upside downside projections, risk rewards for me. Okay. So that's that. I want to have a look at other questions. How we gone? How are we doing for questions? I'm a newbie and started investing 1 month ago, so much to learn, but I started with the belief we were heading for a massive economic collapse based on global debt levels. Geez, Mark, you've overthought that one. So I hedged by applying 20% into a selection of mining shares, gold and silver. Shit, did you dig a tunnel as well? Currently, I'm between 3 and 5% down, depending on the date. Granted, it would be worse. The savings grace is a strong dollar, not going to last. Should I take my losses and cash out and suck it up? Keep it as a hedge for the future potentially inevitable crash. Bloody hell, Mark. Don't outthink the market. Actually, just don't. I don't. Look, I've got 4 degrees. I think I've got 4 degrees. Yeah, I've got 4 degrees. Including in philosophy, politics, economics. They give me the masters for free, and in law. So I'd like to think I know a little bit about the world. I do not make investments on analysis like you've just done. I make it based on the data. Okay. So just be careful about that. Now, my rule is this. If something's up a little or down a little and I want a clean slate, and by up or down a little, I mean 5% either way, then I get the hell out. There is a status quo bias amongst people that they don't want to take a loss. So I can understand why you might not want to. And part of your thesis might be correct. It's just not, I can't comment on it because I don't have the data that I look at. So it's a bit like saying, Alpesh, I've got this Ferrari, can you repair it? And I say, listen, mate, I only can do bicycles. Okay. But several lessons there. Don't be a macroeconomist hedge fund manager. All right. Don't do that. Don't do that. Let me just decline that one. Now, let me close this and go back into this. Ooh, where am I? There I am. Is AutoTrader a good option? I don't know AutoTrader. I'll have a look at it. I think I know it though. Is it that one that draws patterns on charts? No, it's a car. Oh, you mean the car company? Do you mean the stock? Is it a stock? Is AutoTrader a stock? The car company, car advertising thing? I don't know. I've not looked at it. I thought it was some kind of trading software. Evening. Sushila, that was my grandmother's name. Good evening from Birmingham. Oh, okay. I think I've answered all the questions, guys. I might go. I know I'm on TikTok, so I might go now just to my TikTok as well. If you want to follow me on TikTok, I am. By the way, whilst I've got you, be careful of scammers trying to get you into one-to-one conversations. I do not do one-to-one private conversations on TikTok or any social media, other than to say, the only thing I ever say is, no, whoever contacted you wasn't me. What they do is they pretend to be me. They use my name, they use my photo, and then they try and get you onto a one-to-one conversation on Telegram and get you to put crypto money into crypto scamming. It's not me. It's not me. So far, yes. I appreciate the response. Thank you. Opinion. Oh, on Sophie. Sophie. Technologies, yeah. Let me just put it in on this one. Let's just have a look at it from a momentum perspective. So I think, if one of my team said to me, boss, we got an idea. We think we're going to give it a year and as much as a year, and this could give us 50% to the upside if it goes to its highs. And I'd say to them, yeah, how do we know? How quickly will we know we're wrong? Okay, if it drops, if it's going to go up 50, it shouldn't drop to down there, should it? Shouldn't even probably drop to down here. Probably shouldn't drop here. So I'd say to them, listen, drops 12%, get the hell out because you were wrong. And if it hits 50 anytime in the next year, sell half and then worry about the other half going forward. All right, because it might go for the moon. That's just looking at that in 3 seconds. And I haven't looked at any of the fundamentals, okay, at all, I'm afraid. Paul, geez, I need to come return to get that payback. Geez, I need some return to get that. Yeah, I'm afraid it's monthly for 24 months. It's a one-off payment. That's installments. Last question, if you have time, thoughts on Rolls-Royce? Not had a look at it. Bailed at 570 after decline down to 519 following a good bull. I did ask what you thought was causing the UK renewable ETFs stocks to. I've not looked at UK renewable ETFs in detail, so I don't have an opinion on that, I'm afraid, Ian. I'd have to really look into it. I enjoy it. We'll be back. Appreciate it. Thank you, Mark. I really appreciate that. Rolls-Royce. I covered Rolls-Royce on YouTube a few years ago, before it had this massive mental run. And I don't own Rolls-Royce, I should say. Okay, so give me a second. Do you know what? We will do it differently for Rolls-Royce. Let's do it. What time is it? 10. Do you know, I've got a new coffee machine, one of those really expensive Sage machines. And I have drunk, I couldn't get it to work, so I kept making more and more coffee. I have drunk so much coffee, I am not going to sleep tonight. Honestly, I should go for a bloody run or something. It is absolutely insane how much coffee I've had today. And my wife kept putting more in. She goes, oh no, have a bit more, have a bit more. She's fast asleep. But I think I'm going to be pulling an all-nighter tonight, by the way, guys. Rolls-Royce. So I think, when did I cover it? And I think, I might be wrong on this. I did a BBC interview on it, but I might be wrong on that. Anyway, so the breakout happened since then. It's still rising. I mean, what would you do with something like that? Well, the point with this is, you are probably, not that one. I don't want that ugly thing there. Sorry. Remove. The one I wanted is gone. So much harder on this sometimes to draw stuff. Yeah, I wanted to draw a channel. I can't. Anyway, I guess you just put a stop loss. You put a trailing stop loss. You just say if it drops beyond what it's historically done, you might look to exit. You might take some profits already if you're feeling risk averse. But I'd go by your risk appetite, to be honest, on it. That's all. Overnight webinar, I know. Thank you so much, Narendra. Delighted you're all learning so much, and that's really good. I would say if you look at alpeshpatel.com/links, you'll see a whole bunch of links to all my free stuff as well, where you can really learn. One of the ones, this free investing course, especially if you've got kids, I think it's really good. It's completely free. You get a copy of the book as well. Have a look at that, and I think it's a really good place to learn. So how does the approach work out in 2024? Performance is an example, and all of that. Okay, and it teaches people a heck of a lot. All right, with free books, AI, and all of this, and it's all completely free. Do you hold Chinese stocks? Alibaba, I think I've got a small holding in Alibaba. I normally don't hold Chinese stocks, but yeah, no strong conviction on them. Last one, thoughts on Tempest AI. Another one I don't know, Tempest AI. Give me 1 second. Oops. The coffee has definitely kicked in. I'm going to carry this on TikTok after this because I've got a live going on there. Tempest AI. Why can I not see Tempest AI? Do you have the ticker on it? I can see Tempest Therapeutics. By the way, my son and I bought some Dogecoin. Don't do that unless you like to go to treat it like going to Vegas. Yeah, it's been doing all right, but I wouldn't bloody put serious money in it. It's just play money. Because I wanted to show him how markets work. So it was done for fun. As much as taking him to the Science Museum or Disneyland is done for fun, okay? Keep the coffee going, training for Dubai. Yes. Rago, sorry, Tempest. Bloody hell, mate. Don't ask me to look something up and not even know the right name. Tempest AI, I can see it. Okay. Is it? I'm assuming it's a new company. It's a Nasdaq stock. Is it? It's an IPO, isn't it? Yeah, too little data. I'm afraid with IPOs, too little data for me to judge. If I haven't got the data, I can't make the view on it. Because remember, what I'm doing is I'm not doing this on narrative. If I was doing it on narrative, okay, that would be straightforward. It's this, isn't it? Okay, narratives are easy to do. So yeah, it's a new AI is an American health tech company founded by blah, 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 blah. Way too early for me to be able to judge it, I'm afraid. I've written a column in the Financial Times many years ago about why I don't do IPOs on the whole, because the lack of data. And it's the same reason Warren Buffett doesn't. So sorry, not what I would do. Might do incredibly well, who knows? But not for me, I'm afraid. Like I say, I stick to the knitting, stick to what I know, and knowing how to do it. My job is not to mess it up. Imagine I get into Tempest AI, okay, and my wife says to me, "Why we lose a load of money?" I go, "Well, sweetheart, oh look, there you go. How would AI pick stocks if you asked it to be Warren Buffett, Noah President, Eugene Fama?" That's a really good. This is all free. This bit, alpeshpatel.com/links. It's the investing program. Okay, outlooks. Banks 2025, it's over there, the UBS one, and some of the outlooks from last year as well. They're all on there. We've had people do remote internships with me, and they've gone and got jobs at UBS and the like. So do have a look at that. Okay, I'm going to go. I might just continue the live on TikTok. Okay, I'll take it over there onto the talk, as it were. Loving Matt. Oh no, we've got loads coming on. Yeah, XRP. So Ripple, I bought ages ago, and it's made me nothing until this year. And then suddenly I'm up. I'm like, oh shit, I wish I bought loads more now. But I knew to hold it for 10 years and keep my eyes closed, it might still make me nothing. It might still bloody drop. The reason I got into Ripple all those years ago was because, and like I said, I've been underwater until this year. Okay, just in case people think, wow, he knows about crypto. I know bugger all about crypto. It's because Anderson Horowitz are one of the venture capital firms to back it. And Anderson Horowitz in the industry are brutal. They basically throw money at stuff until they win. Okay, and that's what they said they do as well. And they're one of the people behind Ripple. It just happens that my wife met their team. They're big. Anderson Horowitz are behind some of the biggest tech companies in the world. Okay, they're the ones who got in when those companies were private. So, and they got into Ripple. They like to win. They like to win big. They don't advertise, and they're willing to wait. So anyway, I thought, yeah, I'll ride those coattails. Okay. Love it. It's going to be the last one, I'm afraid. Because my throat's hurting a little bit. The thing with TikTok is you can just like go away, make a coffee, and people will still be there. I'm looking at my TikTok. Well, actually, there's not a lot of people on there at the moment, so I might not even do that. App loving. Let's have a look. What's my team put on this? Okay, so similar kind of story, I guess. I mean, 21% drops on this are common. Okay, this can easily drop more, 28, 30, whoops, 30%, and that'd just be noise. So I guess you'd say to yourself from today's levels, where's 30? Maybe you'd put a stop at 30, because you don't want to be holding it if it crashes. I mean, all these people say buy, which is pretty bloody impressive, actually. That's your downside, which isn't too far, and there's your upside projection. Positive case. Now, let me tell you something else about AppLovin. Let me just have a look at some of the fundamentals. Give me a second. I've got so many emails that I've got to reply to, but I'm just hoping things slow down a bit over Christmas so I can catch up. Yeah, I guess the major thing with the company is simply some of that volatility that I mentioned. I think that's the main thing. I'm just trying to think in terms of valuation. Is there an issue? Usually when you've had that bigger move, valuation's an issue. No, revenue is forecasted to grow strongly. Earning per share growth rate 31%. I guess for them, just as long as they don't F it up, you should be fine. Valuation, it's probably fairly valued. It is a bit expensive compared to peers, but the momentum's there. Cadence, Intuit, Synopsys, Workday, arguably our competitors' Cadence. And in that regard, it's a little bit expensive, but I wouldn't care about any of that. I would just say, well, if it drops below there, then I'm getting out. But until then, I'll take the ride. I'd do it on a momentum basis because just the numbers are so strong. And if you treat it as momentum, you'll at least know, that's the worry point because it hasn't tended to drop. I mean, it's interesting because it's a really it hasn't been that volatile this year. Well, since last year, other than to the upside. I don't know what Jefferies have written about it, but yeah, fundamentally, it doesn't look too bad either. Nothing's ever a no-brainer. I mean, you know that, don't you? So I'd probably just say that. Okay, guys, thank you very much. Stas, fantastic. Thanks, brilliant as ever. I love the Doge story. Yeah, enjoy TikTok. I will. I might go on to TikTok. I'll see. There's not loads of people on TikTok, so I might not be on TikTok. I might leave the talk and not bot. Whoops, accidentally turned it off. There we go. There's the talk. So difficult touching an iPhone. Here we go. I'm going to see if I can. What can I do? Anyway, I'm going to go, guys. Email me. Have a look at alpeshpatel.com/links. Thank you all so very much. I'm going to turn off this part on the webinar, but I'll keep the TikTok going. Thank you.